My guest now is James Rickards, who runs a hedge fund in New York called JAC Capital Advisors, and who's published a book called Currency Wars, The Making of the Next Global Crisis, which was published in November last year. Welcome to Business Spectator, James.
Thank you, Alan.
Now, you've been saying some interesting things about currencies, obviously off the back of your book, that the euro you're bullish about,
right.
US dollar going down.
Correct.
Obviously, these are relative prices as opposed to absolute. So perhaps we could start with, why is the US dollar going down, do you think?
Well, the US dollar is going down principally because the United States government wants it to go down. This is the policy of the United States. The Federal Reserve and the Treasury are working together to a much greater extent than has been true historically. Of course, we prize our Fed independence, but because of the crisis of 2008, they've had to come together on policy. And the White House, Treasury, and Fed are united in wanting a lower dollar.
Have they said that?
The President of the United States in January 2010, in his State of the Union address, said it is the policy of the United States to double exports in 5 years. So it begs the question, how are you going to double exports?
But is that the only time that, so apart from that, is it kind of a unstated policy or agreement between the Fed and Treasury?
Sure. You'll never find a Secretary of the Treasury, and you'll never find a Chairman of the Federal Reserve who says, we want a weaker dollar. They will never say that publicly. You have to take it from policy statements from the White House. You also have to take it from their actions. You compare Tim Geithner to Bob Rubin in the 1990s. Bob Rubin was the bondholders' friend, as we called them, advocated a very strong dollar and acted to make that true. Geithner has never done anything publicly or otherwise to encourage a strong dollar. In fact, he's continually berated the Chinese about the fact that their currency should be stronger. Well, if the Chinese currency is stronger, that means the US dollar is weaker. It's a zero-sum game.
And the other thing you pointed out is that they're focusing, in terms of their policy statements, they're focusing on nominal GDP,
right,
which is the addition of real GDP and inflation.
Correct. I like to say, it's always good to keep the math simple, and if you take 1 plus 4, it equals 5, or 4 plus 1 equals 5. So take the first term to be inflation and the second term to be real growth. You combine them, you get nominal growth. Now, the Fed would love 1 plus 4, 1% inflation, 4% real growth, 5% nominal growth. That would be ideal. But they're willing to accept 4% inflation, 1% real growth to get to 5% nominal growth. They need to get the nominal growth because the debt is nominal. You can't pay off nominal debt with, you need nominal growth to pay off nominal debt. They would like low inflation, but they'll accept higher inflation if that's what it takes.
So this means, doesn't it, that there will be QE3?
Very little doubt about it. I think that's exactly right. We may see it as early as the September 13th Federal Open Market Committee meeting. Although the Fed may not call it QE3, it's still monetary easing, it's still printing money, so it's the same thing. They may give it a different name, and the reason is QE2, which goes back to late 2010 through the middle of 2011. The Fed announced in advance that they would buy $600 billion worth of intermediate-term treasuries prior to the end of June 2011. And they did so. But the problem is when you make the announcement, the market immediately discounts the impact of that. And then by the end of the program, the market was saying, okay, Fed, what else have you got? In other words, when you put an end date on it and a quantity on it, the market anticipates it and then looks for more. I think this time the Fed will do a little bit differently. They'll say, look, we're going to buy bonds. We may buy mortgages as well as treasury bonds, but we're not going to put an end date on it, and we're not going to put an amount on it. Therefore, you, the market, are not going to be able to discount what we're doing. We're going to do whatever it takes. So it's a little bit not unlike what Mario Draghi said, whatever it takes. Mario Draghi didn't say how many European sovereign bonds he was going to buy and when. He just said, we're going to make sure the euro doesn't fail, and the Fed is going to make sure that the U.S. economy gets the traction it needs. So there's a lot of coordination going on between the ECB and the Fed on these issues.
Well, that's a good segue into your views about the euro.
Sure.
You're bullish about the euro.
Yes.
Is that because you believe Draghi?
I believe Draghi and I believe Merkel. I like to say that Merkel is the only head of state who understands economics, principally because she's not an economist. She's a scientist. I think she has a much more rigorous understanding and actually common sense understanding of how economies work. But what's going on in Europe, they call it austerity, or at least the Americans call it austerity, but it's really prudence. It's really doing what you need to do to build an economy the right way. The U.S. is trying to drive its economy with return to the old model of debt and borrowing, consumption, high velocity, etc. That hit the wall. Why you think that would work again, I have no idea. Germany is saying to Europe, look, we're going to build an economy on innovation, technology, strong currency, exports, and yes, you've got to get your unit labor costs aligned. The labor costs in the periphery are going to have to come down. But Germany has acknowledged that German labor costs may actually go up.
Have they really?
Yes, they have, because they've recently said, we understand that we cannot run a European currency with German metrics. In other words, if Germany insists on zero inflation at a time when Spain is deflating 2 or 3% and Greece is deflating even more, then that means on a European-wide basis, you're going to have European deflation. Deflation is just as much an enemy of price stability as inflation. So if you're going to have zero inflation on a European basis in a world where Spain's deflating, then Germany needs to inflate more than they have in the past to make that come out even. And Germany has recognized that. And they said, okay, we're going to have a little higher inflation in Germany than we've had in the past, higher unit labor costs, and kind of meet the periphery part way in terms of the adjustment.
But your view that the euro will not only stay together but will rise,
correct,
is based on the proposition, I would have thought, that Italy and Spain in particular will reform their economies. They will deregulate their labour market. There doesn't seem to be a lot of sign of that at this point, but you think there is?
Well, these are democracies after all, and things take time. They can't just do top-down dictation of the kind you see in China. So it is a process, and I think Americans in particular, we're very impatient and we bang the table and say, come on Europe, buy the bonds, do something, get going. It's a much more, look, it took 10 years to launch the euro. Maastricht Treaty was signed in 1991, and the euro came out in stages in 1999 and 2000. So it's going to take a few years to put this fiscal treaty in place, although there's very good progress going from parliament to parliament, and in some cases referendum. The voters have supported this, the parliaments have supported it, so they're moving in the right direction. We're going to get European-wide deposit insurance, European-wide banking regulation. The solution to the potential disintegration of the euro is more Europe. That's the phrase that's being used, and that's exactly what we're saying. It's coming from Brussels and Berlin, and it's basically imposing the German model on the periphery, but it's a very healthy development because it means you'll have an investment and export-driven economy rather than a consumption or debt-driven economy. So that's very healthy for the long run.
But what about the fact that Italy is in recession? Germany appears to be sliding into recession. I mean, the short-term picture does seem to be Europe-wide recession.
There's no question about it, but they'll get through that and emerge on the other end. They'll take their pain now and emerge on the other end in much healthier shape. This is the cost of the adjustment. The problem in the United States is we're in denial about the cost of the adjustment. We don't want a recession. Well, no one wants a recession, but sometimes it's necessary to adjust costs, to adjust asset values. Everyone wants a V-shaped recovery where it goes down and comes back. People don't have the courage of their convictions. A V-shaped recovery can be a very deep V. What we did in the United States, we truncated the V. We got partway down in terms of asset price deflation. But then we said, no, we can't go all the way down. We're going to print money. Well, the problem is you don't get a V, you get an L. The United States is now Japan. Our best case is 10 years of low or no growth. Europe is going to take a hit in the short run, but they'll be positioned for better growth in the long run. That will make them a magnet for Chinese capital. The Chinese are dying to diversify their reserve position. They want to get out of dollars and into euros. They don't want to be suckers. They want to see Europe get its act together. They don't want to come in and bail out Europe, which they could do financially until Europe makes the reforms. But as Europe does make the reforms, massive amount of Chinese capital will come in. This will bolster the euro.
Where will the Chinese capital focus on, do you think?
Infrastructure, technology. There's a lot of things that have been...
But in the periphery?
Oh, in the periphery, sure. They would love to buy Greek ports, power grid, highways, infrastructure, and Italy and Spain as well, technology projects. They're very wary of not repeating the mistakes that the Japanese made in the 80s. You won't find the Chinese buying, golf courses or prestige projects or skyscrapers, etc. They'll make very solid investments, and candidly, they'll look for ways to siphon technology out of Europe and send it back to Japan, which they do very well. The Europeans are sort of forced sellers in some ways. That's what happens when you're in distress. You'll sell things that you would not otherwise want to sell. The Chinese are willing buyers, and they've got the money. So it's a win-win. Europe gets an investment-driven growth model. China gets to diversify the reserves. The U.S. is kind of left out in the cold.
With low growth and inflation, so stagflation.
Correct. That's exactly right. We're sort of heading in that direction.
It's been great talking to you, Jim. Thanks very much.
Thank you, Alan.